In this video, I want to talk about some tips on how to get better entries while scalping. In my opinion, entries and execution is the most important aspect to putting a trade on. In order to get a good trade, in order to get a profitable one, we have to have a good entry, and our execution has to be what I call flawless. And in this video, besides the tips that I'm going to explain help me, I'm confident they're going to help everybody watching this out as well. But really, to get better at executing and get better with entries, you must execute yourself. You must do it in order to get better at it. It's something you truly understand once you learn the concepts and then go implement it yourself in the market with your real money. Before we get into it, I recommend everybody watching this to follow me on my Instagram at Ameritrade. The link will be in the description below to follow me. I post daily trading recaps on here, along with really good trading tips and tricks that I guarantee you're not going to find anywhere else. The link will be in the description below. You're missing out if you're not following it. But now let's get right into the charts. The first thing that I want everybody to understand is I want you all to look at the market just like any other auction, whether we're talking about real estate, cars, watches. The stock market is relatable because it's an auction place where buyers and sellers are looking to exchange goods. A lot of people view the market just as a candlestick chart. They look at patterns on the candlestick, they look at the volume, and they think they could guess where the market is going. Now, that's valid in certain occasions, but I want everybody to think of the market differently and understand that it is an auction. To validate this point even further, we can look at the level 2, we can look at the time and sales, and this gives us a numerical value other than looking at the charts to tell us what the auction is doing, where buyers are buying, where sellers are selling, and completed transactions coming into the market. Just like real estate, you could have someone that's selling a house. They put their offer on the market looking to sell a house for, let's just say, $500,000. And for them to sell that house, a buyer has to come, accept their offer, and then we have a completed transaction where a buyer buys that house and a seller sells that house to that buyer. The same concepts apply in the stock market, and this is very important for scalping because if you are scalping or even just trading in general, you are looking to gauge what the auction is doing. So I want everybody to look at candlestick charts a little differently now because what candles show us is where price was in the past and where it currently is. It doesn't give us any really information other than that, and it doesn't give us so much information about the market auction. What we have here is the market will move up until the last buyer buys and until the passive sellers on the offer are stronger than aggressive buyers looking to lift that offer. And then the market also moves down until the last seller sells or the passive buyers outweigh the aggressiveness from sellers. That's how the stock market moves, and that's how the market is relatable just to any other auction. Any other auction will move up, price will shut off completely to the upside once the last buyer buys, and the market will shut off completely to the downside, and the last price will be sold into once the last seller sells. So to scalp efficiently, in my honest opinion, you need to look at the market just like an auction place. In fact, the concepts back in the pit trading days, in the 70s, the 80s, early 90s, the concepts still remain the same. The market is structured the same way. The only thing that is different now is computer technology, algorithms, and a bunch of retail traders understanding that candlestick charts, but not so much of an understanding of the actual auction and how orders move the market, not the candles themselves. With this in mind, specifically for myself, I would say 90% of the trades that I take are on the S&P 500 and the NASDAQ. Whether you trade futures, whether you trade SPY, SPX options, QQQ options, it doesn't really matter. The market is very, very liquid. And when you're trading a liquid name, such as the S&P or the NASDAQ, understanding order flow is vital, especially if you are a short-term scalper. In my opinion, just based off how I trade, what I have success with is I cannot do sole analysis off of a candlestick chart. As I mentioned earlier, all candlestick charts show us is where the market was in the past and where it currently is relating to price. It doesn't go behind the candlestick charts, meaning in this example, we see the market downtrending. And what somebody looking at a candlestick chart is going to see is, yes, we're coming down, But you don't know that even though the market's coming down, you might have a buyer looking to unload a position or maybe open up a new position, and that's going to give us important piece of information about the auction and the context of an intraday move. When I say order flow or the flows of the market, you can use any price and volume tool, supply and demand zones, support resistance, tools like bookmap, which is what I do personally use myself. It's a very, very good order flow tool, in my opinion. You may have missed information, and a historical heat map can make you go back and see things in the short term that you may have missed. Level 2, time and sales, is basically the bottom foundation of everything, and other tools like bookmap, volume profile, market profile, delta, footprint charts, anything relating to orders coming into the market and you reading the auction of buyers and sellers is going to give us true action in the present moment when it actually happens. The problem with candlestick charts and why majority of retail traders use them is specifically, and I'm not against candlestick charts, I use them myself, but if I am scalping, I need to know the orders coming into the market via order flow. In this example, when the market came down right here, if I show you this replay system on bookmap, what you're going to see is as the market was coming down, here's this very large downtrend that I was explaining earlier. As we come down into this demand zone, you're going to see a lot of sellers who are trapped at the lows. They're aggressively hitting the market inside of a demand zone, and then we consolidate. We see a bid step into the market. We consolidate a heavy offer, and then look at the aggressive prints, aka aggressive market buy orders coming into the market. Now this is around 9:51 Eastern when the market looks just like this. So this tells us that we can get into the market right here before the move actually happens. If we use a candlestick chart or we look at normal historical volume, which I still personally use, it's still very important in my analysis, the move might have got us in up here now about 13 points higher, delaying our reaction and skewing our risk to reward, which does not make it efficient if we are scalping. And another thing I do want to mention, because I get a lot of questions about this, is, what do I look for specifically? And to be honest, there's not something specific that I look for. I put pieces to the puzzle together reading the order flow. It's not so simple that, we see green orders come in and let's buy it, or we see red orders come in and we sell it. It's more complex than that. If it's as easy as like somebody's grandma could do it, is my new favorite analogy, then in my opinion, it's not going to be as efficient. It's more about understanding the speed of the orders coming in, the velocity of the orders, the size of them, the reaction of the market after that, and putting context together with levels off of a candlestick chart. When you implement the context of a candlestick chart and the scenarios of this, combined with a shorter time frame perspective of the order flow, it's very, very powerful. So here's a trading scenario on the S&P 500 on January 5th from the pre-market plan. I post these every single day in my Discord, setups I'm watching, levels I'm looking out for, and potential trading scenarios. So scenario number 1 was a bearish one where we were looking to find sellers at this 3880 supply zone. I wanted to play short targeting 3840. Now, if you trade futures, the beautiful thing of that is you could trade the overnight session, where this setup worked out very, very well in the overnight session. We got the sell off from supply and we hit our 3840 target. Now, when the market opened, there was another setup confirming the charts with short-term order flow analysis. This was that if we can break 3840, which is this green line on my charts here, it was not the strongest level, then I want to play the market short targeting 3825. This was a short-term scalp. Now, what I'm going to explain here, and the third concept to this strategy of getting better entries with scalping, is you must understand the difference between volatility and momentum, combine them into one term, versus scenarios where there is no volatility or where there is no momentum. So this trading setup I'm going to show you right here is a perfect example of when you should scalp, when there is momentum and when there is volatility in the market. And then the next setup I'm going to show you is one where you should be trend trading or not looking to scalp because there is no volatility or there is no momentum in the market. So what we see here is the market sells off into our 3840 level. Again, from the plan, we're looking to short below 3840, targeting 3825. Now, opening up this order flow tool, again, this is the easiest way for me to show you these examples is with this tool. I use other tools on a daily basis, But to show you this replay, what we're going to do is I'm going to speed it up. And what you see on the charts here is every green bubble is an aggressive market buy order. Every red bubble is an aggressive market sell order. Every line under price on the heat map is a passive buyer. And every line above price is a passive seller. This paints the auction between buyers and sellers, not only historical data in case we miss something, but also in real-time data as it's forming. So what we're going to see here is price is at 3840. The move leading up into this level, there was aggressive market sellers coming into this level, and then we consolidate. You can see the consolidation also on a candlestick chart. And now what we're going to see here is I'm going to speed up the replay. Keep an eye on the momentum, keep an eye on the volume and the volatility as it comes into the market when we break 3840. Now I took the market short at 938 when we broke 3840. A very large passive bidder got taken away by aggressive sellers, aka red market bubbles. Look at this velocity and the momentum, obviously speed up. See how that order just came through and took it away very, very fast. Watch the pressure continue, selling pressure increase, and then look at that beautiful clean sell-off right into 3825. This is what you want to see if you are taking the market short. Now, what's interesting to note here is where this 3825 level came from. Here's that sell-off, was actually from a candlestick chart. So when you implement levels, maybe off of other tools than candlestick charts as well, and combine it with reading the auction at those levels, this may give us a very high quality system to scalp the market efficiently. It's just putting the pieces together, understanding when you scalp, that is the velocity, that is the momentum, that is the speed of the tape is what I call it, that you want to see when you are scalping, because the move should happen quick and in your favor right away. Now here's another example of a move with not so much volume, not so much momentum, not so much velocity. The speed of the tape was very, very slow. And this is a setup that if you are looking to scalp it, I would either recommend going smaller size or turn a scalp into a trend trade, because the conditions do not fit the criteria that you need for a scalp. So in the pre-market plan on the 6th of January, what we were watching for was not to be so bullish at this little red box up here at supply. I said I only want to be play long today if we can get above 3888 within the first hour. If we can rally, get above 3888, and it acts as support, I want to play long, targeting 3927. This happens before the market opens up. I send these plans out. This is not hindsight trading. This is going with levels in the market and understanding the flows that come in. I look at the market as an ocean, right? Think of the waves coming in. Sometimes they're going to be unpredictable. The waves might be more violent and vicious than the past. Sometimes the temperatures change. Sometimes the height of those waves are smaller or larger. It's like an ocean. It's constantly changing, it's dynamic, and it adapts consistently. And as a trader, to trade the market consistently, proficiently, and efficiently, we must adapt with the constant changing of the tides and the waves of the ocean. In order to trade successfully, we must go with the flows of the waves and go with the flows of the markets. 1 minute we might be bullish, 1 minute we might be bearish, but we must go with these flows. So in this example from the plan, we wanted 3888 to act as support. Well, guess what happened when the market opened up? We got this rally above 3888, which is this red line up here. 1 time, 2 times, 3 times, 4, 5, 6, 7 different times. In, I would say, about a 2-hour period, 388 acted as support. Now, for this setup, this really did not give the volume. As you can see, volume was kind of dead over here. And if you look at volume by price, it also was kind of slow and dead. The tape wasn't very fast, and it didn't offer a good opportunity to scalp. So with this, either you go with the intention of not scalping and trend trading it, maybe trade smaller size, and look to capitalize on a longer time frame day trade instead of a very quick scalp that it might only last, a matter of seconds or minutes. Doesn't matter what time frame you use. If you are scalping, I personally myself use either a 1 minute chart or just look at the orders coming into the market to enter the setups. I don't go anything higher than that. And I don't rely so much on the candles to tell me when to enter. I rely on the orders coming in. But 3888 acted as support very, very well. And then we got that rally perfectly into 3927. Again, these levels are not made up after the fact. These are levels that we were watching in the plan before the market opens up. We hit our 3927 target very well. And I mean, these levels, it was just a perfect trade. But this was an example where the momentum was a little lacking. So instead of trying to scalp it, maybe go in with large size, looking for a fast move, understand that we might not get it because the conditions don't fit and there's not a lot of momentum in the market. Although the plan and the levels worked out well, it just did not really fit a scalp. Also, when you were looking to enter, when you're scalping and you want to get better at entering and execution, you cannot hesitate. The minute you think too much, fear starts creeping in. The minute you think too much, you're going to delay your entry. If you delay your entry when you are scalping, you are going to skew your risk to reward. When you skew your risk to reward, you cannot afford to lose as much as you can when your risk to reward is in your favor. Now, also, if you hesitate, you think too much. For example, let's go back to this setup that I took on that 3840 break. Let's just say I didn't enter when I did get in originally, but let's just say I waited. Let's just say I waited for maybe a candlestick chart to break a low or, high volume to come in on a vertical basis. Then I would have gotten short, let's just say, at this oval. Now, for my analysis to be incorrect, it would have to be at this high right here. So now I'm risking about 13 points where my target is only 5 points away. It just would not make sense to get short at this oval with a stop loss above this high if we did hesitate and we didn't enter when the market told us to enter. You can't think too much. As soon as you see something, you got to attack. A split second might destroy your account. But if you didn't hesitate and you got in when the market told you to, when I got in, it was a 5-point risk for a 15-point reward. It was a 3-to-1 risk to reward. I was risking 5 points to this previous high to make about 13, 15 points to the downside. So do not hesitate. Less thinking is better thinking. Less analysis is more analysis. I hope you all got something out of this video. If you did, drop a like, comment any questions. I'll go through the comments, and definitely check out the links in the description below. I offer a very in-depth course, which also includes Discord at no extra charge. It's a one-time fee, and it is a very, very active, engaging, and very helpful community that everybody is looking out for one another. But I'm going to end it on that note. Peace out.